Welcome to Accounting 100. We are going to be covering Chapter 1 today, which is Accounting in Action. And I usually upload my PowerPoint presentation that I use in the lecture within Blackboard. So make sure you download that and use that as you please, as you see it fit. I will try to go as slow as possible. And if you have any questions, just please let me know. Contact me by email. Again, this is Accounting 100, and we will start with Chapter 1, which is Accounting in Action. Based on your introduction responses, many of you are pursuing a career in accounting by either running your own business or by working for a company as a CPA. So no matter if you are a business owner or work for someone else, it is important to have good financial information and know how to use it to make effective business decisions. In other words, or the bottom line is, you need to know the numbers. So let's begin by identifying the different types of businesses that will be discussed in your book. We have proprietorship, which is a business owned by one person. This is mostly what happens in the small business world. We also have a partnership, which is business owned by two or more persons. And then we have a corporation, which is a business as a separate legal entity, and the ownership is divided into transferable shares of stock. The corporation will be most likely known to you as anything in the stock market. And the partnerships, if you have a small business and you want to invest with somebody else, that would be your partnership. But if you're the sole owner, then it will be the proprietorship. Now, before we go into the accounting principles for Chapter 1, I want to get two assumptions straight when it comes to accounting. In accounting, we have two assumptions that provide the foundation in the accounting process. One of it is monetary unit consumption. And this requires that the company or business include accounting records that can be expressed in money terms. Anything that deals with exchanging money, that will be used in order to record transactions. And the second assumption is the economic entity assumption, which requires that activities of a business or a company and the owner is kept separately. For example, let's say you are the sole business owner of your restaurant and you own a home and you need to pay a mortgage on that. Most likely you're going to be taking the profits out of your restaurant for your personal use, and you will be recording that in a recording transaction that I will be showing you later. However, you're not going to record that you are paying your mortgage within the accounting records of your business. That is strictly separate, that entitles to your personal life. You will be recording that you are withdrawing money from the business for personal use, but you are not going to be afterwards recording your mortgage payment. So, this is a little video that I found in YouTube that I would like to show you, and it explains the basics of accounting. So let's see if it works.
We've been told before. What is accounting? Accounting is the language of business. Well, what is business? Well, you could say business is like somebody taking a hammer, building a house, and then taking his stuff that he made and selling it to somebody with money. Then they make their exchange and it's all good. Another way to look at business is that it is a magical box. You take raw materials, put it in the box, and then it comes out as goods that you can then sell and make money. That box is business. So let's say you have a business. You make something that costs you $100 to make and you sell it for $200. You have a profit of $100 and you're happy. I just told you a story about a business that made $100. So who should we tell our story to? You might want to tell your story to banks or investors. Banks or investors want to hear your story because they might want to lend you money or invest money in your business. Another person who wants to hear your story is Uncle Sam. He wants to tax you. We could break it down into 3 different people that want to hear your story. People on the inside, or internal users. People on the outside, external users, or the government. The language by which you tell these people's stories is sometimes called managerial accounting for internal users, financial accounting for external users, and then tax accounting for government users. If you've ever taken an accounting class, it's usually going to be called managerial, financial, or tax. The actual language that external users want to hear your information in is GAAP, GAAP, which stands for Generally Accepted Accounting Principles. The government wants to hear your story based on the Internal Revenue Code. That is the standard by which you must tell your story. Now, internal users, what's the name of the language that they want to hear? It's actually whatever you want. There is no standard managerial accounting language. If you're a business and you're talking to an external user, you want to look good or show that you made a high profit. Everyone wants to brag about how good their business is doing. However, when you talk to the government, your objective is to make it look like you made nothing. Because if you're rich, they'll take all your money. Now, if you're talking to an internal user, your objective isn't really to look good or to look like you made nothing. It's really just to tell it as accurately as you can, because that's the information upon which managers and decision makers will make decisions. Now, your story might be the exact same story in every instance, but depending on who your audience is, you're going to use a different language. And each of these languages will actually tell a different story, even though it's based on the same actions of the business. In review, accounting is the language of business. Business is when you do stuff for profit. When you tell the story of your business, you're going to be telling it to one of a few different options. Internal users want to hear your story based on the language of managerial accounting. External users want to hear it based on GAAP, and the government wants to hear it based on the tax code. For more videos like this, visit accountingwit.com.
So that's a little video that's going to sum up what we're going to be discussing today for Chapter 1, which are the very basics. In the video, it says that when you're taking an accounting class, it's either managerial or the other one was tax, accounting. Here we call it Accounting 100, Accounting for Business, because these are just a little bit of everything that you can use for your business. But it also prepares you to go into the more specific accounting courses, like the managerial or the tax accounting. So there are 3 types of activities in the accounting process. And if you look at this picture here, the 3 activities is identification, recording, and communication. So let's just follow this picture here for visual. A company, first of all, or a business identifies the economic events relevant to its business. So you might be asking to yourself, what are relevant economic events? As I said earlier, we have the number 1 assumption that we only record transactions in monetary form. So a relevant economic event is the sales of products. Like, let's say you own a snack shop. You're going to be selling snacks, or providing a service. Perhaps you own an insurance business where you provide insurance coverage, or maybe you own your tax business where you prepare taxes for others. Or perhaps you are paying in employee wages. You have employees that work under you and you pay them bi-monthly. Then those would be relevant economic events. As you notice, I mentioned 3. Sales of products, providing a service, or payment of employee wages. All those are monetary economic events. So basically, any event that relates to money, where you exchange money. For example, let me give you a different view to this. How about if in your business you just hired a cashier clerk? Do you think that this is a relevant economic event that needs to be recorded in the accounting process? I hope that your answer is no, and it's not at this point. This cashier clerk is not getting paid on the day of the hire. Maybe in 2 weeks, this person will earn a paycheck. So at the point where the person earns a paycheck, then this will become a relevant economic event. Okay, so that's the identification. Once an economic event is identified, the company or business records the economic event in order to provide history of its financial activities. These records are systematic, chronological diary of events measured in dollars and cents. Again, we have the monetary value when it comes to relevant economic events. Then finally, the company or the business communicates the events to interested users via accounting reports. These reports are known as financial statements. Okay? So who uses accounting data? We have two types of users in accounting, and this was covered in the video as well. We have internal users, such as managers and owners, and these are people who can run or who run a business. So in this visual, we have different types of internal users, and I will go over each one so you understand why or where this picture is coming from. We have financial directors or finance directors who must answer questions such as, is there enough cash to pay dividends to stakeholders? And this will apply to those that are in the stock market where there are dividends for interested stakeholders that needs to be paid. Then we have marketing managers who must answer questions like, what price should Apple charge for an iPad? And that question is asked because it is necessary to know in order to maximize a company's net income. Then we have the human resource managers who must answer questions like, can the company afford to give employees a raise this year? And then we have managers for production who must answer questions like, which product line is more profitable and should a product line be eliminated? And they give you the example of Pepsi-Cola or the Pepsi company that has two product lines, the snack chips and the beverages. So which one is more profitable and which one should be cut? So to answer these questions, internal users need detailed information or reports to help users make decisions. This is where managerial accounting comes in, which was mentioned in the video. Okay, and then we have external users, which are individuals outside of the company or business. So we have investors who want financial information about a business or a company to decide if they want to invest, if they want to buy, or they want to sell the shares. And then we have creditors, like bankers, who are the financial or who use the financial information of a company or business to decide if credit or loans should be given to them. And this is where financial accounting comes in, which was also mentioned in the video in terms of ways of communicating. So accountants must follow a set of standards in reporting financial information. And for these standards to work, there must be ethical behavior within the accountants. And I'm going to show you a little video that talks about the Sarbanes-Oxley Act, which resulted based on some unethical activities that were happening in some of these corporations that were in the stock market. So let's see if this is going to work. Yes.
In late 2001, people began to notice some accounting irregularities with a large publicly traded company. The company had a national reputation for consistency in both good times and bad, so it was considered a blue-chip stock. The name of this company was Enron. Within weeks, the stock went from over $90 a share to being nearly worthless. This occurred because the management team tried to cover up losses from the previous years by altering their financial statements. The deception that occurred gave the public a reality check, and in effect, investors started taking a look into the financial records of other large corporations. The Sarbanes-Oxley Act was introduced into Congress by U.S. Senator Paul Sarbanes of Maryland and U.S. Representative Michael Oxley of Ohio. Their intention was to create a law which would restore the faith of investors back into corporate America. By imposing stricter standards on financial reporting, there would be an increase in the reliability of the financial statements created by any given company. Let's take a deeper look at what the Sarbanes-Oxley Act includes. First, officers of the company are required to sign financial statements for accuracy. This holds them personally accountable for any misrepresented data. Second, an increased fine and/or prison sentence was set for individuals who attempt to defraud investors or misrepresent actual figures. Third, the company must provide a description of its internal controls. This is an attempt to increase the confidence of the public in that organization, while allowing them to gain an insight into the company's procedures. Fourth, the company is responsible for hiring an independent accounting firm to come in and audit the accuracy of their financial reports. The financial reports are now required to have a section dedicated to the auditor's opinion as to the accuracy of the figures presented in the reports. Fifth, the company is now mandated to report all off-balance sheet transactions on their reports. Finally, the Securities and Exchange Commission is given more power to look into companies that are suspected of wrongdoing. The SEC will now do random reviews of companies to ensure that they are complying with the Sarbanes-Oxley Act. Their reports are then published and released to the public for viewing. The SEC has a special division that is designated to work with Sarbanes-Oxley issues. This division is called the Public Company Accounting Oversight Board. Video helped to educate you in the world of Sarbanes-Oxley.
Okay, that's another little good video that summarizes what Sarbanes-Oxley Act is. And so as stated in the YouTube video, we have Generally Accepted Accounting Principles, also known as GAAP, which are standards that indicate how to report economic accounting events. Now, the Financial Accounting Standards Board, or known as FASB, develops the accounting standards and is the primary accounting standard setting body in the U.S. And the Securities and Exchange Commission oversees U.S. financial markets, and is the agency of the U.S. government. So you might be asking yourself, why do we have standards? So that financial reports are in a consistent manner. Think of the stock market and think if we did not have standardized financial reports for each company, we as consumers or investors would have a very hard time knowing the financial stability of a company because we would have different types of reports. So the accounting standards standardizes these reports, which are helpful in the stock market. And let's go on to the measurements of principles. GAAP uses one of two measurement principles that are here. One of them is a historical cost principle, where the cost of the investment is reported as purchased throughout its lifetime. So let me give you an example that you might relate to. Let's say you buy a property for $1 million in 2015, and if the property at the end of 2016 is $1,500,000, under the historical cost principle, the property is still reported as $1 million. And that is because that's the recorded asset at the cost, regardless of the current value. The fair value principle, however, reports the fair value of the property on the year reported, so that at the end of 2016, the property will be reported at $1,500,000. And I hope that makes sense. Now, we are going to be using the basic accounting equation. This is going to be your best friend for the remainder of the semester. This one and the expanded accounting equation, which I will cover in a few minutes. But the basic accounting equation is assets equals liabilities plus owner's equity. And like I said, the basic elements of a business is what it owns and what it owes. Assets is what a business owns. Like, for example, if you have a restaurant, you own the chairs, the tables, a truck used for deliveries. Those would be your assets. Liabilities and owner's equity are the rights or claims against these resources. So for liabilities, the liabilities are claims to whom the company owes money to. For example, let's go back to the restaurant example. You buy supplies and you buy them on a credit card. That is money that is going to be recorded under liabilities because you owe that money to someone else. Owner's equity, on the other hand, are claims of owners. And in order for me to clarify this even more, think of it like this. Let's say that you are the business owner of your restaurant and you want to retire, and you're going to retire by closing the business. You're not going to sell it. The assets is what you own. It could be the property, like I said, it's the chairs, it's the tables, it's the truck. And that property is what you own before you close the business. But before you close the business, you need to clear all of your debt. Perhaps you owe rent if you don't own the property that where you run your business. You owe wages to your employees that you are about to lay off. Or you owe a balance on a delivery truck that you had purchased, but it's still, you still owe like $1,000, $2,000. Or you have a balance on your credit card. And so these are your liabilities. You owe money to some other people. But after you pay your liabilities, whatever else is left is what belongs to you as the owner. That is owner's equity. So if at any point you want to know what you own. Let's say you want to know what your balance of, or if at any point you want to know how much you own and what's yours at any point in time, you would be able to find out by subtracting your liabilities from your assets. And that would be your owner's equity, which would be whatever you own, and it's going to go to you. Now, your owner's equity can increase or decrease during the life of your business. And this is where the expanded equation of accounting comes in. I just told you that assets equals liabilities plus owner's equity. And I usually like to use the first letter of each of these components. So A equals L plus OE, which is assets equals liabilities plus owner's equity. But then we also have the expanded accounting equation. Assets equals liabilities plus owner's equity has several components. It has owner's capital minus owner's drawings plus revenues minus expenses. So this would be the expanded accounting equation. Assets equals liabilities plus owner's equity minus owner's drawings plus revenues minus expenses. These two equations are going to be your best friends for the remainder of the semester. And before I go on, I want to explain to you what each of these components consists of. So we're going to begin with assets. Assets are resources that a business owns. For example, like we were talking about the restaurant, we have tables, we have chairs, refrigerators, cash register, stands, even cash, etc. All those are assets. And within the asset equation, and within the accounting equation, there's going to be accounts in assets. And these are the 4 accounts that we're going to be working on for this chapter. We have the cash account, which is obviously any cash that comes in and out of a business. Accounts receivable, which is money that you owe, that is owed by a customer, and I will go over that in a few minutes. So accounts receivable, think of it like you own a restaurant and there's different forms of payment when you offer a service. They may pay you in cash or they may use a credit card. Anytime they pay you with a credit card, that it's money that is still not in your hands. You're going to have to process those credit card transactions and then receive money or cash later. So in the meantime, in order to record those transactions, you're going to put them into the accounts receivable account. And like I said, in a few minutes, we'll go over it more specifically. Then we have equipment, like the chairs and the tables. And every time we buy any equipment, we're going to record it under the equipment account. And every time we have to buy supplies, like food ingredients, then we're going to record those transactions into the supplies account. So let me just go over the assets again, and I'm going to do the same for the remainder of the accounting equation. Assets are resources that a business owns. And an example for a restaurant is tables, chairs, refrigerators, cash registers, stands, and cash. And then we're going to be dealing with 4 different accounts in the assets part of the equation. Cash, which is money liquid that's coming in and out. Accounts receivable, which is money that is owed by a customer to your business. Equipment, which is chairs and tables. And supplies, which is food ingredients. It may be paper cups. It may be trays to go. Then we have liabilities. And these are claims against the assets. These are debts and obligations. Like I stated earlier, you may have charged things on your credit card, or you have a credit line by the bank to buy a truck. All those are liabilities. And so in our example of a restaurant, we have food supplies, we have ingredients. Maybe you bought a business truck using a line of credit through the bank. And then you may have employee salaries. This is really not a relevant, I don't want to confuse you, so just ignore the employee salaries for now. And so then we have the liabilities accounts. We have accounts payable, which are anything that you charge on a credit card. I'm just going to be using the credit card example so that I know how to differentiate that to you. Every time you hear accounts payable, it's like stuff that you charge on credit. It may be your snacks, your beverages, and you pay them on credit to your suppliers. Then there's the other liabilities account, which is notes payable, which we go back to the line of credit when buying a truck or a vehicle. And then we have the salaries and wages payable. You may owe employee salaries, and that's where they will go. Then we have the owner's equity. In owner's equity, if you remember from the expanded equation, we have owner's capital minus owner's drawings, revenues, and expenses. And owner's equity is going to be your residual equity. So after you close your business, like I gave you the example earlier, after you pay your liabilities, the residual equity is what the ownership claims on the total assets. And we're going to be dealing with 4 accounts, which is owner's capital. Owner's capital is when an owner makes an investment in its business. So let's say you want to open up a restaurant and you want to invest your own money that you have, maybe your life savings, it will be recorded under owner's capital. Owner's drawing is when the owner withdraws cash. So let's say at the end of every month, you're going to pay yourself as the business owner, you're going to withdraw cash for your own personal use, and that's going to be recorded in owner's drawings. Revenues is pretty self-explanatory. Every time you make a sale, that's going to go into your revenues account. And expenses is it's pretty self-explanatory as well. Every time you need to pay your rent, you need to pay wages, you need to pay marketing tools, all those will go under expenses. So let's go back to what I was saying that owner's equity can increase or decrease during the life of your business. So what makes owner's equity increase? Owner's equity is going to increase when there's an investment by the owner. And that's because you're going to invest money into your business, and your business is going to be worth more. And like I said earlier, you would be recording that under owner's capital. And it could also increase because you have revenues. You're making sales in your business. This increases your business activity, and you would record that under the revenues account. Okay, so what decreases owner's equity? 2 components decreases owner's equity. One of them is drawings. That's when the owner withdraws cash for personal use. Like I said, maybe you're paying yourself at the very end of the month. That's going to be your living income to pay your expenses at home. That's going to be recorded under drawings. And the expenses are costs of assets used in the process of earning revenue. So for example, when you buy supplies, you pay rent, you pay wages, these are reported under expenses. And just to recap, the basic equation is assets equals liabilities plus owner's equity. And the expanded equation is assets equals liabilities plus owner's capital minus owner's drawings plus revenues minus expenses. And what I'm going to show you is different types of transactions that you're going to be dealing with in this chapter and are going to be relevant as well for your homework assignment. So let's start with transaction number 1. And we're going to pretend that you are the business owner and you're going to open up a restaurant. So how do we use these equations to report accounting transactions? So let's continue with our assumption that you are a business owner. And let's go back in time to where you decided to open up this business. So let's pretend you are going to open a restaurant So you decide you are going to invest your life savings into this business venture. And on January 1st, 2016, you invested $30,000. How are you going to record this transaction? Well, you first need to ask yourself, is investing money in a business an asset, a liability, or is it part of owner's equity? Is investing money part of assets, liabilities, or owner's equity? Well, $30,000 that you're going to be investing is cash. This is coming from your life savings, and cash is an account under assets. Okay? Remember, let's go back over here where we have assets. We have 4 different types of accounts: cash, accounts receivable, equipment, and supplies. In this case, you are going to invest $30,000 in cash to your business. So you are going to be recording that under your cash account. So when we record an accounting transaction, we must make sure that it affects at least 2 places within the accounting equation. For those familiar with algebra, back in the days, we were often told that what you do to one side of the equation, you must do to the other side of the equation. So we have assets equals liabilities plus owner's equity. So $30,000 in cash is an asset. So what we need to do is add an account under assets, and we name it cash, which I did right here. Okay, whoops. And we are going to record the investment by adding $30,000 into that account, which is the plus $30,000 right here. Then, now you need to, does this investment affect liabilities in any way? Do you think it affects liabilities ever when you invest money? Well, no. We're not paying any bills under this transaction, so we leave it alone, which is why it's blank. So now let's go to owner's equity. How does this investment affect owner's equity? As mentioned earlier, owner's equity increases when there are investments by the owner or by increased revenues. In this case, it is increasing because the owner, you, are investing in the business. And if you remember, an investment by owners are recorded under owner's capital. So we add $30,000 under owner's capital. Now, we do one last thing. We need to ask, does this record balance? And the way that you do that, you just need to make sure that assets equals liabilities plus owner's equity. We have $30,000 in cash, so when I add all the transactions under assets, and you're going to figure out what I'm doing later, but eventually you're going to have various transactions under the asset account, and you're going to need to add them. And then what I do here is I put the total in red. And then you do the same thing for owner's capital. You add all the transactions. Here we just have one because we're just deciding to open a business and we're going to invest money. And the total is $30,000. So you need to make sure that assets equals liabilities plus owner's equity. In this case, we have $30,000 equals $30,000. So yes, it's balanced. So we are good to go. And we are done with recording this accounting transaction. That's all you got to do for this number 1 transaction. When you invest money, it affects the cash account under assets, and it affects the owner's capital account under owner's equity. So, this is how we will continue to record transactions. We're going to determine the accounts that it affects. And remember that it must affect at least 2 accounts. and the equation amount must be equal in the accounting equation. In other words, assets equals liabilities plus owner's equity. So let's continue with transaction number 2. Now, you as the business owner have invested money in the business, and your goal is to open up a restaurant. So what is next? Well, you need to purchase equipment maybe. So let's say you are going to purchase equipment such as a stove, blenders, tables, chairs, a cash register, tablecloths, etc. All of this is equipment needed to run your restaurant. So you are going to buy all the equipment in cash, and it's going to be for $10,000. This is what transaction 2 is requiring you to record. So, what account does this transaction affect? Remember in the previous slides, the assets has various accounts. One of them is cash. The other one was equipment, supplies, and accounts receivable. Well, we're dealing with equipment right here. And you're going to start noticing a pattern that there are keywords that you need to look for when you are evaluating a transaction in order to determine what accounts it affects in the accounting equation. So we are buying equipment for $10,000. So we are going to be affecting this or recording the transaction under equipment. And so we're going to add a category here. We're going to add $10,000. And remember, like I said, it must affect at least 2 accounts under the accounting equation. And what we're going to be doing is also going to be affecting the cash account because you're paying it with cash. So that's why we also record minus $10,000 under the cash account. We invested $30,000 in cash into the cash account, but now we're going to be buying $10,000 worth of equipment. So we need to subtract that from the cash account. If we do that, 30,000 minus 10,000 equals 20,000, which is my total balance in red. Equipment, we started with 0 equipment. Now we bought $10,000 worth of equipment, which is an asset. So our equipment account is going to be at 10,000. Nothing is happening with liabilities yet. We're not paying anybody. We're not owing any money to anyone yet because we paid it with cash. And under owner's equity, under owner's capital, nothing happened. It did not affect this transaction. So we keep it at 30,000 for the balance on owner's capital. And then what we need to do is making sure that assets equals liabilities plus owner's equity. We have under assets, we have 20,000 plus 10,000, which gives you your blue total for 30,000. And the liabilities plus owner's equity is 0 plus 30,000. So we have a balance of 30,000. In this case, assets equals 30,000 equals liabilities plus owner's equity, which is another 30,000. So it's balanced and we're good to go. So make sure that at the end of each transaction, make sure that your equation still balances so that you are sure that you're on the right track. So for transaction number 3, you invested your money for your restaurant, you bought some equipment, now you need to buy some supplies. Maybe you want to buy, I don't know, to-go trays. Maybe you want to buy some ingredients for your food that you're going to be cooking. And let's say that you buy them, all these supplies are going to equal to $5,000 and you're going to buy it on credit. You're not going to use your cash account this time. You're going to leave your cash alone and you opened up a credit line and you're going to pay with a credit card. This is another keyword, credit. So what's going to happen here is you're going to be adding it's going to be affecting the supplies account under assets because you are buying supplies. And you're going to record it there as a positive $5,000. And then you're going to buy this stuff on credit. So now that this is where liabilities comes in. Anything that you owe money to anyone, it goes under liabilities. But when you buy it on credit, you're going to put it under accounts payable. And you're going to add it as positive $5,000. And then what you're going to be doing is you're going to be adding each of these columns to make sure you get your balance on each of the accounts. Cash, it's still the same, nothing happens, so it remains at $20,000. For supplies, you added $5,000 in supplies to your assets, so now you have $5,000 in your supplies account. Equipment remains the same at $10,000. For accounts payable, you owe now $5,000 in credit, so you make sure you record that under accounts payable. And owner's capital remains the same, so we leave it at $30,000. Then the last thing we need to make sure is that our equation is balanced. So we need to make sure that assets equals liabilities plus owner's equity. So we have assets is $20,000 plus $5,000 plus $10,000, which is equal to $35,000. And liabilities plus owner's equity is $5,000 plus $30,000 equals $35,000. For transaction number 4, now you have your supplies, you got your equipment, you invested your money, now you're ready to make some money, right? Now you're ready to open up your restaurant and hopefully make sales. And so you do. You make sales for $1,000 and all of your customers paid you in cash. So what are the accounts that it's going to affect? The key word is we have cash and we made sales. Sales is revenues. So this transaction is going to affect the cash account and the revenues account. Notice that I'm adding columns, I'm adding accounts as we go with each of these transactions. You made sales in cash, so that means money came in cash into your hands and you're going to deposit that into your cash account. The reason why I added $1,000 on your cash account. Notice that your supplies account is not affected, your equipment account is not affected, accounts payable is not affected, owner's capital is not affected, but your revenues is because you made sales. So make sure you record that as a positive $1,000. And then what you're going to do, you're going to add each of these columns to obtain the totals that are in red. We have 30 minus 20,000. 30 minus 10,000 equals 20,000. Then you made $1,000 in sales. Now you have 21,000. And you bring down the totals in each of the accounts. And then you make sure that the equation is balanced, that assets equals liabilities plus owner's equity. In this case, assets is 21,000 plus 5,000 plus 10,000 equals 36,000. And your liabilities plus owner's equity is 5,000 plus 30,000 plus 1,000 equals 36,000. They're balanced, you're good to go. Now, let's say that you want to start advertising your restaurant, your new restaurant, so you purchase marketing for $500 on credit. Here we go with the credit keyword again. And you purchased something, which means that you have an expense now. So you owe money to your credit card now because you're going to charge it to your credit card. And then you also have an expense now. Now you have to pay for that marketing that you have purchased. Notice that cash is not affected, supplies is not affected, equipment is not affected, but accounts payable is because you're buying things on credit. Owner's capital is not affected, revenue is not affected, but your expense account has been added and it is affected. So we're going to record liabilities and accounts payable for $500. Notice it's a positive. And anything that comes into as expenses, make sure you record it as a minus 500 or as a minus whatever the amount is. Then you make sure that you add each of your columns. We have 21,000, 5,000, 10,000. Now notice here that now this increases to 5,500 because you first had $5,000 charged for your supplies, but now you're buying marketing materials for 500. So now you owe 5,500 on your credit card. Owner's capital stays the same at 30. Revenues at 1,000, and then your expense account is now minus $500. Make sure that your equation balances. So 21,000 plus 5,000 plus 10,000 is 36,000, and your liabilities plus owner's equity is 5,500 plus 30,000 plus 1,000 minus 500, which is 36,000. Now, your businesses continue to thrive, so now you make another $1,000 in sales. This time, $500 was paid in cash, and 500 of those were paid to you by credit. So the customers use their credit card to pay you for those meals. That means you don't have the money in your hands yet, so you're not going to record the entire $1,000 into your cash account because only $500 are in your hands. The rest of them are paper receipts that you need to process with the credit card company to receive that cash. So how do we record this? This is going to be one of the transactions as an example that it affects at least 2 accounts. That's the key word. It has to affect at least 2 accounts. So it means it could affect more than 2. And this is the prime example that explains that. We have cash that's affected. We received $500 in cash, so we record it in our cash account. The other remaining $500 is owed to us. We have not made that money. Well, we made the money, but we don't have that money in our hands yet. But we know it's coming. Every time we know that money is coming because we've made a sale, we're going to add that under assets, under accounts receivable, which is why I added this column here, and you're going to add it as plus $500. The other account that's affected is your revenues because you made another $1,000. So you're going to record that under your revenues account. It's under owner's equity. Notice that there's 3 accounts that are affected for this transaction. Then what you do is you make sure you add each of the columns to get those balances in red. And then you make sure that your equation balances, your assets equals your liabilities plus owner's equity, which they do. Notice I'm cutting the explanation shorter and shorter because it's just a loop that we're going to be working on. It's basically identifying what their transaction is, what accounts it affects, putting them in those accounts, adding the columns to make sure you add the totals, and making sure that the equation balances. Those are the steps that you're going to be taking for this week's homework assignments. Transaction number 7. Now it's time for you to make payment on your rent. You rent an establishment, perhaps in the mall, and you have to pay $2,000 in cash for that. You're not going to be charging it to your credit card. You're just going to pay it out of your cash account. Again, you have to look for those keywords. We have expenses and we have cash. So we know that our expense account is going to be affected and our cash account. We're going to go into our cash account and we're going to minus $2,000 because we're paying $2,000 in cash to someone else. And then we're going to add the expense for minus $2,000 under the expense column. Make sure you add each of the columns for the new totals in red. Make sure you check the equation balances. Assets equals liabilities plus owner's equity. If they do, you're good to go and you can continue with the next transaction. Now, you think you're evaluating the books and you think that now you can start paying some of the money that you owe on your credit card. So transaction number 8 is owner makes payment for $3,000 in cash for credit purchases. We have keywords as cash and we're going to pay credit purchases. Credit purchases, remember, every time you see credit, it's accounts payable. And cash is cash. So we're going to minus $3,000 because we're going to take out $3,000 from that account to pay your credit card bill, which means that you are going to minus $3,000 off of your accounts payable balance. You first charged $5,000 in supplies, then you've bought $500 worth of marketing, which gave you a balance of $5,500, but now you're going to pay $3,000, which gives you a new balance of $2,500. Add all of your columns to find the balances in red. Make sure that your equation balances. Assets equals liabilities plus owner's equity. They balance. You're good to go. So now it's time that you pay yourself. Okay? So owner withdraws $2,000 in cash for personal use. Personal use, maybe you want to use it to pay your own rent, pay your own bills at home. So what you're going to be doing is every time you hear owner's withdraws, that's going to be owner's drawings. And you're going to take it out of your cash account. So your cash account is going to be affected. So we're going to go to our cash account, take away $2,000, which brings your account to your new balance. And then you're going to make sure that you record that as a minus on your owner's drawings as well, because you're taking out money from your equity now. Okay? When you do that, you're going to check that each column balance, all the totals from each of the columns to find the red values, and then you're going to make sure that your equation is balanced. Assets equals liabilities plus owner's equity, and we're back at $30,000. Those are the different transactions that you're going to be encountering in your homework assignment. Your homework assignment is going to be consisting of a transaction analysis using a tabular summary of transaction form, which is actually an Excel file. I'll show you how to use it in a minute. But it's very important that you know that your accounting equation, which is assets equals liabilities plus owner's equity, and that you know the expanded form. And that you also remember the types of accounts that are within assets, the types of accounts that are within liabilities, and the types of accounts that are within owner's equity. I suggest you print out this PowerPoint presentation, make notes, and use it for your homework. But here is the overall summary of the different scenarios that I just covered. Every time that an owner invests cash in the business, it affects the cash account, and you record it as a plus whatever that dollar amount is. And it affects owner's capital, and you also record it as a plus dollar of whatever the amount is. When you pay cash for expenses, it's going to affect your cash account. You're going to minus it. And it's going to affect your expenses account, which you're going to minus as well. When you purchase equipment and you pay it in cash, it's going to affect your cash account as a minus and your equipment account as a plus. When you gain a cost on account, let's say you buy supplies or you buy a vehicle on a line of credit, it's going to affect your accounts payable, and it's going to affect your expenses. Every time you provide a service, but you only receive the partial payment in cash and the rest of it on account or on credit, they use a credit card to pay you, it's going to affect 3 accounts. Remember, this is the one transaction that it affects more than 2. It's going to affect your cash account. So you're going to add that. You're going to have an account. It's going to affect your accounts payable as a plus, and your revenues as a plus. And every time you withdraw cash for personal use, you're going to minus the cash account, and you're going to minus the owner's drawings. Okay? Also, what we're going to be going to learn later on in this course is the financial statements. This is the way that you report the financial health of your business. And so we have to take certain accounting data and prepare reports based on these 4 financial statements. We're going to have the income statement, the owner's equity statement, the balance sheet, and the statement of cash flows. Now we'll be going over that later in another lecture. So that's it for this chapter. What we're going to be doing now is going over your homework assignment. And in your homework, in your week folder, you're going to see the chapter from the ebook version. For those of you that didn't purchase the actual book, you could see the electronic version here. I've included the PowerPoint presentation, which I just covered. And I'm going to ask you to complete your reading lecture assignment for chapter 1. Every time, for every chapter, I'm going to have this assignment. And this is just to ensure that you are reading the material. They're going to be basic questions. Usually they're going to be multiple choice. So make sure that you are reading your textbook, whether it's a hard copy at home or you are using the ebook version. And this is your homework assignment for this week. It's going to be due again this coming Sunday by 11:59 p.m. What you're going to do is open it up. This is the only time that you're going to be doing a homework assignment that's not in Wiley. This is going to be done in an Excel file. Let me see if I have it downloaded here. Yes, I do. And this is what it looks like. You need to make sure that you go over all of these transactions here and record them in this spreadsheet here, in this Excel sheet. This is recording in tabular form. And once you complete that, save it with your name on it on the file name, and send it over to me before Sunday by 11:59 p.m. If you don't submit it on time, remember it's going to be considered late and you are going to be losing points. So this is how you do it. This tells you that on April 1st, this company established, or this person, Renato, established the Renato's Travel Agency. And the following transactions were completed during the month, or the month of April. You're going to be going through each of the transactions. There's 10 transactions. I went over several of them during the lecture. And you're going to be recording them depending on the account that it affects. And I made it easy for you for this week. I actually identified in yellow the accounts that it affects. So there's no way that you're going to be lost for this week. It should be pretty self-explanatory, very straightforward. The first one, we're going to do the first one together. Renato invested $15,000 in cash to start the agency. Remember, investment is going to affect owner's capital, and cash is going to affect the cash account. So, remember that you either put in the number as either plus or minus. If it's going to be plus, you don't need to put the plus for it in Excel. Just put the dollar amount, which is $15,000. But when it comes to minusing, do put the minus, okay? So when it comes to the expense account, make sure that you put the minus first and then the dollar amount. But for here, it's invested $15,000 in cash to start the agency. So you know it's going to affect $15,000. You're going to deposit $15,000 into your cash account, and your owner's capital is going to be increasing by $15,000. And notice at the bottom, I already included all the formulas for you, so you don't have to worry about that. It's giving you the column totals and it's giving you in blue if the equation is being balanced. If for some reason 15,000 does not equal 15,000, you did something wrong. That's the way you're going to check your balances. And like I said, this is going to be the easiest way, a homework assignment, because it's already identified for you. I just need you to go through the motions to make sure that you are understanding. But in the future, you're expected to know, without me telling you or providing these yellow boxes, which account affects what account, which transaction affects which accounts, okay? You need to know that. So in the future, this is not going to be provided for you. You'll see that in your Wiley Plus assignments that it's not provided for you. You have to decide where it goes. And that's it for transaction number 1. So then I'm going to do transaction number 2, and that's it. You do the rest. Paid cash, $600 in cash for April for office rent. Paid $600 in cash, that's your keyword, for April office rent is an expense. Okay? So we're going to minus $600 out of our cash account. And we are going to add the expense as a minus $600. And if you notice at the bottom, it totaled your columns, okay? And it checked if the equation is balanced, which it is. And that is all you got to do. Go through each of these transactions and figure out where it goes, which is I giving you the huge clues. And once you're done, save it with your name in the file name and send it over to me before the due date. Okay, and then the last thing that you got to do is your quiz. I give you a quiz right here. And what you got to do is, just like the reading and the lecture assignment, all you got to do is click it. Okay, you're going to click it, and it's going to open up a new page for Wiley Plus. Many of you were having issues. We're saying that it's not loading. I'm going to say it once again. Make sure that your pop-up blocker is off, or it's going to take you into a loop and it's going to take you back to the page that where you were before. If you see this page, then you are good to go. You're in Wiley, and it's going to give you 3 problems. All you got to do is click on the first one, go through the questions, answer them, click next, and it's going to take you to the next one. Click next, and it's going to take you to the next one. Okay? Notice that this one's not going to give you the answers here for tabular form. And don't even try to copy my answers, because each student is going to have different numbers than mine, or you're going to have different numbers than your classmates as well. I do that on purpose. And then you're going to have, for your lecture assignment, then you're going to click in there again. Click there. It's going to take you to your Wiley Plus page and answer the questions and submit it. Okay, so it's going to take you to your Wiley page, and here it is. You have 10 multiple choice questions. You click on the first one. Once you do that first one, click on next and next and next until it takes you to the last one, okay? Many people have asked that they have gone into the Wiley Plus website, wileyplus.com, and try to look for my course. You're not going to gain my course through that website. I've said that before as well. If you're listening to my lectures, I'm showing you how to get into your homework assignment. It's all going to be accessed through Blackboard. You just got to go into that week that we are in, click on the links, and do what you have to do there. There's no reason why you need to be going into an off-site website. My course is not going to be there. Okay? All of this assignments are due by Sunday, 11:59 p.m., or it's considered late. Please let me know if you have any questions. I will be here to help you. And good luck to you. And I'll see you next week.